Today on the Meet Kevin Report, number 5, Meet Kevin talks about inflection points in the marketplace, the Federal Reserve's response to the inversion of the yield curve, mortgage interest rates, Apple's credit card and Apple stock, problems at the FHA, problems at Tesla, problems at Samsung, and maybe even problems with home builders and consumers. And I'm your host, Meet Kevin. What's up, everybody? Welcome to Meet Kevin Report number 5. Today might end up being worse news than some random dude driving his car into a mob boss's car in New York, the Gambino mob boss, getting out and talking to the guy, then deciding to shoot the guy 6 times, and then claiming that he has no affiliation with the mob. Okay, folks, in all seriousness, let's get started by talking about inflection points in the marketplace, because inflection points are going to be what make you a much more savvy and successful real estate investor, stock investor, Bitcoin investor, whatever floats your boat investor. You will learn from being able to identify inflection points. Now, I was inspired to bring up this topic because a lot of people think I'm somewhat bipolar when it comes to talking about the market. That sometimes it's good and sometimes it's bad. And these are people who seem to think that real estate trends in only one direction. That is a relatively flat line. And while that may be true over the long run, it is anything but true in the short term. And it leaves me wondering, where would people get this idea from that real estate over the last year or year and a half has only trended in a straight line?
This is what housing in America is doing right now. It's the lowest it has been in almost 35 years. At the same time, interest rates in America, guess what they did? No, they went down too.
Now, while it's super convenient to portray real estate as always moving in a straight line, and this is oftentimes why I think when people read video titles, they think there's like this bipolarness or madness going on, but in reality, when we look at real estate, we can identify that, wow, there are a lot of opportunities to make money based on what's going on. Here's a quick representation of sort of real estate pricing since 2005. We get sort of the run up. At the end of 2005, we see our first inflection point, and we kind of go through the chart to where we are now in 2019. And to me, this is a great opportunity to just take a moment here and explain, folks, what are inflection points? Inflection points are changes in the slope. So when we see this sort of change in slope right here, we know, we should pay attention. But usually inflection points are followed by other inflection points. So we can kind of see the slope changes, and then we know, this is something we should pay attention to. This is much the same as to when prices shot up 10 to 20% in the beginning of 2003, much the same as when they dropped 8 to 13% over here in the summer of 2018, as mortgage interest rates were at a crazy peak. Now, mortgage interest rates, fortunately, are down. The market's been a little volatile since then, but here's something super important. I put my money where my mouth is. So last summer, remember, I'm a real estate broker. Last summer, I ended up selling a property right around here because I saw this inflection point and ended up renting another property somewhere between here where I decided, no, let's not sell that property, which both of them were supposed to be flips. Ended up selling one of them and keeping the other one of them. And I told buyers, maybe now's not the time to buy because I'm feeling a little bit of a free fall. Now, then when we sort of hit the bottom at the end of 2018, what did I recommend? I said, you know what? Q1 might be a good time to swoop up on an opportunity. So what did I do? I closed escrow on a house at the end of Feb, somewhere right around here. Now, obviously, right now it's too soon to determine what's going to happen going forward. I think we're adjusting to sort of a new normal of significantly slower growth, sort of payback for the growth that we've had over the last 10 years. But who knows? There could be hyperinflation, there could be deflation, we could be going into a depression. There are a lot of things that could happen. And what are the most important things? Well, this is where I agree with Grant Cardone when he says,
You do not want cash in a recession. You want cash flow.
Number 1, reallocate assets to things that produce cash flow. I agree with this. Try to stay away and minimize negative cash flows. Try to insulate yourself by protecting yourself with more cash flows, which in real estate usually means putting more money down. Residential real estate, you could get away with putting 5-10% down, but that might be a negative cash flow if you have to rent out the property. This is why in big deal real estate, you generally put 35 to 45% down. You force cash flow by putting more money down, which you could do on the small deal as well if you're just getting started. Additionally, reducing taxes should be a no-brainer and is really bundled with number 3, which is spend on your business where you will see growth, and then take the tax write-offs to help insulate yourself in slower times. Great arguments here, Grant. I definitely support these arguments by Grant. Now, none of this is to scale, obviously, but what's kind of funny about the inverted yield curve, or the inversion of the yield curve, is that as soon as we had the little, like, boop, it inverted, the entire market exploded, and everybody overreacted over this little boop happening here. Markets weren't super sure what was going to happen. Stocks fell, Chinese stocks fell, US stocks fell, German stocks fell, French stocks fell, but the Federal Reserve Chairman over in Dallas, Texas, comes in and swoops in with a little bit of reassurance, although he either knows secrets that we don't know or he's lying to us. So let's find out a little bit more about what he says. Basically, Mr. Kaplan, Robert Kaplan, suggests that we're gonna have to see, before we freak out in reality and maybe even consider reducing interest rates at the Fed, we're gonna have to see some more magnitude of the inversion of the yield curve, and we're going to have to see that extend for a longer period of time rather than just dipping. And honestly, I can't argue with that. We did have quite the freak out for this boop, a little bit of a cross there. So I appreciate that sort of, okay, rein me in, bring me back to normal here, all right? Which I did mention in Meet Kevin Report 4 that we should be careful to be patient because this just happened. Let's see if this sustains for 2 to 3 months. That inversion did happen on Friday, but we know that after an inversion happens, it has to stay inverted for 3 months before technically, or at least in theory, we'll see a recession within the next 18 to 24 months. Now, there was one thing in this Wall Street Journal article where somebody named Megan actually comes out and sort of in a really complicated way sort of says, hey, you know what? This market is kind of weird because we have this basket of good news, we have this basket of bad news, and everything is just kind of inconsistent, but consistently saying things are going to slow. So we consistently know things are going to slow, but in terms of, is the market gonna keep going? Is the market gonna plummet? We have very, very inconsistent data to that effect, which to me, I'm kind of hedging along the middle of the road and just saying, you know what? Keep wedging real estate. Now, speaking of mortgage interest rates, let's pull up what's going on in the mortgage rate sector because, folks, it is excellent news. And what happens when mortgage rates go down? Well, prices generally go up, and there are more opportunities to buy great wedge deals in real estate before the market realizes what's happening and comps adjust. You could probably swoop into some deals and take advantage of these new lower rates. Take a look at some of the charts here. Let's compare. We've got the 15-year down to about 3.4%, the 30-year down to 3.8%. Within the last month, you can see how volatile they've been. Year over year, we're down nearly 0.2% on the 30-year fixed rate loan, which is the loan I recommend all of you get. And we are still up over the 2-year horizon, but rates are still pretty low, and who knows, I mean, right now, they're trending downwards, so could be a good time to wait on the sidelines a little bit and decide, do I want to refinance my loan? Do I want to take out some cash and go buy some deals now that prices are lower than where they were about a year ago? We've got Jeremy over at Financial Education saying, hey, you know what, this is kind of like things are on a 10% off sale. Kind of like Meet Kevin's real estate investing course that's 17% off, and you should join using St. Kevin. Moving over to Apple. Apple has announced its sort of leap into the services sector from a product sector, that is by providing and announcing a new credit card, sponsored essentially by Apple, but backed by Goldman and serviced by MasterCard. Apple has introduced a basically zero-fee credit card, probably unless you're late, but we're not sure about that. And, you know, maybe doesn't have the most benefits in terms of, well, perks that we've seen yet. For example, I'm not sure if we've seen any kind of travel protections, extended warranty protections, or other common perks like rental car protection or insurance coverages. But what we do know is that the card's going to offer you 1% cash back on all your purchases, and 2% back if you use Apple Pay, 3% if you buy at Apple, but those are more rare purchases. Only problem with this is a lot of merchants don't even know that they have Apple Pay, and then a bunch of others don't actually have Apple Pay. So even Goldman Sachs here thinks that the odds of people getting 2% back pretty low. So we're not looking at this Apple Card by any means as any kind of rewards card, but what it is a great leap into a new societal push towards greater transparency and greater security. Without actually having credit card numbers on the card, we now see credit cards moving into hopefully a significantly safer direction with less credit card fraud and identity theft, which would be wonderful. Maybe that would alleviate the need for me constantly telling you to freeze your credit, although I probably still will be freezing my credit all of the time. Now, I am tempted to apply for the Apple credit card. That is, I'll have to unfreeze my credit, apply for the card, and then freeze my credit again, mostly because I want to support the move towards greater transparency. That is, transparency in showing you your expenditures on that card directly within the app, being able to dispute charges within the app, which do note that other companies have done already as well, such as the Citi Double Cash Card, which I have 2 of, one for business and one for personal, an amazing 2% cash back card that most YouTubers that I've found that talk about credit cards also support. But I will say I am blown away by the feature to identify the location of where an expense was made. That way, next time I go buy parking at a parking structure and later on the statement see things like PCB now $27, and I'm like, that ain't me, dispute, only to find out it was a parking structure while I was on vacation, I can now probably rest assured thinking, oh yeah, that's what that is, by looking at the map. Not a bad idea, Apple. I support the move. And hey, you know what? Moves like this are gonna pressure the entire credit card industry to evolve their businesses, and I like evolution in business. Now, folks, I think this is a great opportunity just to shout out Andrew Fay and his father. Andrew, thank you so much for sending me the message that your father is a seasoned businessman and real estate investor, and that Andrew's father is impressed with how I explained some complex principles in a very clear way. This was a message Andrew sent me on Instagram. Thank you so much for following me there and messaging me there, obviously in reference to the real estate investing course, where we go in detail A to Z on everything you need to know about real estate, including wholesaling, buy and hold, multifamily, large deals, small deals, you name it, we talk about everything. I won't let my biases eliminate any knowledge from what you're looking for. Note also that Miguelo compliments me for actually responding to comments and questions in our private Discord, and folks, if you join, rest assured, I'll be there to help you as well. Now, going back to Apple, what does this mean for the Apple stock? Well, folks, the Apple stock, as is classic, falls after any kind of Apple announcements. This pretty much happens every single year. But folks, I am still bullish on the Apple stock. I have been bullish on the Apple stock for probably over a decade now, and it's certainly gone up and down through one heck of a roller coaster, but I'm bullish on it. With its price to earnings ratio of just 15.47, I'm bullish on the long run growth of Apple to continue to be an innovator. Of course, we're not going to see the big one more thing like we've been used to, but hey, you know what? I'm still supportive of the company. Everything I own is pretty much Apple, and maybe that's bad because maybe I'm just a fanboy, which is kind of how I feel about Tesla. Moving on over to Tesla and Samsung, we noticed that Tesla sales have actually declined substantially in the first quarter of 2019. Now, part of that is because the federal tax credit for buying a Tesla halved at the end of 2018, so many people buying Teslas were highly incentivized to make that purchase at the end of 2018, and now, according to the Wall Street Journal, the automaker is suffering what is called payback. That is, they have to suffer for lower sales now because they essentially ran a discount coupon last year. Samsung, on the other hand, came out and surprised the world by saying, you know what, we're expecting way slower and lower profits, and part of that is because of lower profits from the chip side of the Samsung industry or marketplace. That may be because of chips becoming cheaper to produce and more competition for chips, but this could also be due to our Trump versus China tariff battle. We will see what happens here, but so far, these bad news items, I see rationalizations for. Not necessarily a good thing to rationalize things in the marketplace, but they don't leave me as concerned as if I didn't have a rationalization for those problems. Now we're gonna jump on over to Reuters and their updates on builder confidence and consumer confidence. And no surprise here, both builder confidence and consumer confidence has declined, but hey, how could it not after the roller coaster of a year we went through in 2018, both by seeing price declines in real estate and price declines in the stock market, only to be partially regained at the beginning of 2019. Now, there is something I want to say. This is what I'm going to call another rationalization here. Not necessarily correct to do, but we're going to do it anyway. Keep in mind that home builder confidence, when we see the market zoom, it tends to go up because builders like to hang their hat on the future of what the market will do. Keep in mind, you usually have a 2-year period of time that you have to wait from a plan or project being approved to a plan or project actually completing. This is why we saw massive home builder confidence at the beginning of 2018, and I came out in the summer and said, you guys better get off your high horse because you're about to get hammered. And sure enough, home builder confidence has plummeted since then. Why? Because real estate prices have fallen. And we've kind of been doing this, so all of a sudden it becomes significantly harder for builders to actually feel confident about what's to happen over this next period of time in the event they want to actually start projects. This is a very reasonable assumption and makes sense, so the fact that home builder confidence is down is no surprise to me. All of this shenanigan stuff happening last year also means I'm not surprised that consumers are less confident about the economy as well, which leads into my favorite bottom line about consumer confidence. When consumer confidence falls, and this, could contribute to the market slowing down anyway. But I do recommend you consider spending less, paying off high interest debt, and taking less risks. Folks, it's fun to take risks when the market is zooming because you can be insulated by your investments, but relying on insulation from your investments is a bad idea when the market is a little tumultuous. Moving on over to the Federal Housing Administration, the FHA, popular for its 3.5% down payment program, is tightening lending standards. What does that mean? Well, not much for most people. They're really only tightening lending standards on people with credit scores of under 620 and debt to income ratios of over 43%, which is somewhat a subprime category anyway, so it's probably a good thing that we go back to manual underwriting for these kind of borrowers, which is just a fancy way of saying there's going to be less reliance on the FHA approval software to approve buyers for FHA homebuyer loans. And keep in mind, I bought my first property with an FHA 203K renovation loan, which meant I could put 3.5% down on a foreclosure fixer-upper and buy a sick wedge deal with just 3.5% out of pocket. Now last, and this is sort of a little bonus here, we now have 19 states officially requiring a financial literacy exam on budgeting and basic finances prior to you getting your high school diploma. This is up from just 13 states requiring this back in 2011. Not necessarily the fastest growth, but still growth nonetheless. Definitely a move into the right direction. So thank you very much to these states for now requiring financial literacy. I feel like we should have required this a long time ago. And something else that we should have done a long time ago is hit that little red subscribe button and the notification bell, as well as following me on the Instagram so that you can DM me any questions you have, whether it is about real estate, life, entrepreneurship, the course, whatever you got. The best way to reach me is through DM on Instagram. Do know, though, that I'm not epically fast on Instagram, but I do make it a point to get back to everybody. Thanks so much for watching, and we'll see you next time.